Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Today's show is brought to you by YCharts. Keeping your research teams and advisors on the same page can be tough, especially when the market's moving fast. We've all experienced times when inefficient communication between teams leads to duplicated efforts, missed deadlines, and frustration. But that's where YCharts comes in. With real-time access to your firm's proprietary model portfolios, advisors are always dialed in, ready to handle client questions, compare portfolios, and propose new solutions without any of the usual headaches. Whether you're onboarding new advisors, bringing in an entire team, or making big acquisitions, YCharts helps you scale with ease. Advisors get up to speed fast, clients transition seamlessly into your proprietary models, and before you know it, you're seeing real AUM growth. At the end of the day, it's about creating one firm and one voice. YCharts makes sure everyone's aligned, driving efficiency, cohesion, and making your firm run like clockwork. Click the link in the show notes to explore why YCharts is the go-to platform Cambria has used for years and get 20% off your initial YCharts professional subscription when you start your free YCharts trial and tell them Meb sent you. New customers only. Welcome back, everybody. We got another awesome show today. We're joined by Dr. Bryan Taylor, President and Chief Economist for Global Financial Data, which provides the most comprehensive historical, economic, and financial information available anywhere. He's published some great research lately on market concentration, different financial errors going back not one, but two, but 8 centuries. So we had to have him back on the show to get into all these topics. Bryan, welcome back.
Thank you very much.
You have been on the show a bunch, and so listeners will put Bryan's past episodes in the show notes. But for those who don't know Bryan, he's up there, maybe my favorite market historian / librarian. And I actually heard you on another podcast. I think it was Rational Reminder. Great podcast, by the way. And you got to qualify the statement for me because it was amazing. If you've read my papers, listeners, you would have seen the phrase source, global financial data, littered throughout all of them, throughout the books, throughout blog posts. And you had a stat about how many academic papers have cited y'all's data. Could you tell the listeners just how many that is?
It's well over 1,000 because we went on to Google Scholar, did the research, and over 1,000 came up. We've been used by Nobel Prize winners. We've been used for the past 20 years. And virtually every major school in the world subscribes to our database and uses it as a source to publish their papers.
I love it. So you could make the argument that Bryan and his company is like single-handedly more responsible for financial education and sharing than just about anyone out there, up there with French and Fama and all the other folks. But anyway, it's great. Anytime I'm looking for something, no matter how esoteric it is, you guys are my first stop. So, of course, we had to get you back on. The number one word cloud topic of 2024 has certainly been market concentration. I think it's shifted to the election a little bit, but for most of the year with investment markets was talking about concentration. You've written a piece on this. Maybe get us started. Start talking a little bit about where do we stand today, and then also put that in the context of history.
Well, right now you have the Magnificent Seven. And if you look at their concentration, what we did was we went over the past 150 years of stock market history in the United States. And we have data on every company that's listed in the United States back to the 1790s. So when we looked at it, what we found out was that today, stock market is the most concentrated it has been in history. Now, the way that we define concentrated is the share of the top 10 companies as a percentage of the top 500. And right now, that percentage is around 34, 35%. So over 1/3 of the market cap of the top 500 companies is concentrated in the top 10 companies. Now, when we're looking back, what we wanted to do is to see a couple things. One, has the market been as concentrated as this in the past? And two, what are the consequences of that market concentration? I think the current concern is that since the market is currently so concentrated that at some point in time in the near future, that market concentration would collapse along with the market, and those larger firms would pull the rest of the market down. So we want to see, is that true? When the market was this concentrated in the past, did it lead to a bear market? Did the larger companies collapse? What exactly happened? Well, we found that there were 3 cases where the market concentration was as high as it was currently. The first occurred when the railroads dominated the U.S. stock market back in the mid-1800s. And at that point in time, Chicago was the nexus, the point where all of the railroads grew out of for the rest of the United States. And so at one point, the top 10 companies were all transport companies. The second occurred during the 1950s and the 1960s. The stock market was very stable during the 40s, 50s, and 60s, early 60s. And so you had what we called the old Magnificent Seven. And there were 7 companies that dominated the market during the 50s and 60s, and just as you have the Magnificent Seven today. Now, the 7 companies back then were General Motors, AT&T, IBM, Standard Oil, which of course now is ExxonMobil. Then you had General Electric, DuPont, and U.S. Steel. Now, at that point in time, DuPont actually owned 23% of General Motors, and the government launched an action against them and forced DuPont to divest its shares in General Motors. After the 1960s, you had the technological growth begin. Then in the 1970s, you had the energy companies growing in power. And so the concentration gradually declined. But what you want to look at is, did the market collapse when the concentration was so high in the 1960s? And the answer is no, it did not. In fact, the market continued to do well throughout the 1960s and into the early 1970s until OPEC really hit the market bad, and you had the bear market in 73. But for those who are wondering, since you have 3 companies, they're over $3 trillion, which are Apple, NVIDIA, and Microsoft. Is it too concentrated? Is it going to blow up and affect the stock market? It didn't happen in the 1960s. Also, the current trend of market concentration has been going on for 10 years now, whereas the previous periods lasted for about 20 years. So we're sort of in mid-cycle here. We're not towards the end of the cycle when the market would start to move out and expand into other areas. But inevitably, is what will happen. So my prediction, just based upon the past, is that the bull market should continue for the rest of the 2020s. There's no reason to fear a collapse in the market in the immediate future.
It's like you look to some of the other examples in history, and the U.S. is obviously the biggest stock market, and it has been for the majority of its history, but not always. You and I were chatting about on this on an email. But if you look at individual countries, for example, you had times where Nokia or Nortel, or even now with Novo in Denmark, maybe, where a single stock gets to be like 70% of these countries. Obviously, they're much smaller, but there's no hard and fast limit on these types of size. By the time this podcast publishes, NVIDIA is flirting with breaking out to all-time highs. I mean, who knows? It could be up or down 50% by the time this publishes, but it's fun to watch. Where one of the favorite things you guys have done, and we tweeted it out, where we were talking about like what was the largest company at every sort of benchmark, like the world's first 10 million, 100 million, billion, $10 billion company to our next milestone is the first $10 trillion company. What's your prediction? When's that going to happen? 2027? What do you think? Who's it going to be? NVIDIA? Google?
Right now, it's hard to tell, obviously. But for the first $10 trillion company, I still think that would be at least a decade off. Because the first billion-dollar company was Standard Oil. And then the first trillion-dollar company, it's actually a Japanese company for a brief period of time, but really it was Apple more than anyone else. And that just happened a few years ago. And then now you have three companies over at $3 trillion. And there are 10 companies in the world now that are $1 trillion or almost $1 trillion, including two foreign companies, Saudi Aramco and Taiwan Semiconductor. Taiwan Semi is almost $1 trillion company.
This is why I like having you on the show. It's like doing a Jeopardy facts where one time, finally, I was in LA and there's a great little Irish bar where the serious trivia people go called the Irish Times. And I'm not particularly that useful as a partner on the team. I'm kind of esoteric knowledge. And so finally, when they did a question about what was the world's first stock market, I finally was able to contribute. Now, looking back on it, I realized this could probably have an asterisk on it because I said Amsterdam and got the question right because I figured that's what they were asking. But I think there was were there any exchanges or gatherings before that? Or is that kind of well agreed upon? That was the first.
There were exchanges, but not in stocks. They did commodities and foreign exchange. But the first stock exchange was definitely Amsterdam, 1602.
Okay, I feel better now. But Bloomberg does these pub financial market quiz nights. They do them in New York. And I was telling, I think it was Joe or somebody else there. I said, well, you guys do one in LA. Let me know. I'll sponsor it. And I'll drag you out to put you on my team.
Yeah, I would have fun there.
All right. So when you look at some of these lessons of history, it's hard because sometimes, even though we have a few hundred years as a statistician, like that doesn't feel like that much. And you look at things like, hey, this is the most concentrated ever. But even then, that doesn't mean it has to crash or it has to go down. It might, but it doesn't mean it has to. But at least it gives you a lens at which to see the world. And you just did a really fun paper that's 83 pages, listeners. So dig in, print it out, called 5 Financial Eras, where it looks at the past 8 centuries, which is pretty amazing. Talk to us a little bit about this paper.
The origin of the 5 Financial Eras paper is that there's a large interest in the equity risk premium. What is the difference in return between stocks and bonds? When do stocks outperform bonds or vice versa? And by how much? And so we're able to use this long-term data to see what were the fluctuations in the equity risk premium over time. Was it stable? Did it fluctuate? And what we found out is that it fluctuated dramatically and it changes over time. There will be periods of 20 years when the equity risk premium is very high, such as it was back in the 1980s, back in the 1960s. And then there are periods when the equity risk premium was very low, such as the 1970s, after 2000 as interest rates declined and bond yields declined. And then there can be surprises. I mean, the bond market turned in its worst performance in history during 2021 and 2022 because the central banks had pushed interest rates down to unimaginable levels. Yields on bonds were negative in Europe, and they were 1% or even below at some point in the United States. Then you had the inflation coming out of COVID. And so the central banks had to raise interest rates. And so bonds lost 20% over a period of 2 years. And that's the worst performance of the bond market in history. Now, that's a done deal. It's a sunk cost. It's already been done. And it's not going to happen again.
I was just thinking about this topic the other day about what is the most obvious trade when I look back on it that I didn't make. I mean, there's things like, hey, I clearly should have been going all in March 2009. But look, the world was ending. Lehman was failing, like a lot of things. Yes, that's obvious, but also not that obvious. Like you could have come up with a scenario where it could have kept going down and blah, blah, blah. But looking back at the period of zero and negative yielding bond yields, like the me of now is like, Meb, how did you not just short the ever living everything out of these negative yielding or zero yielding bonds? Like that seems like such an obvious, in retrospect, trade to have made. And like some trend followers did, but most didn't really. But that was a weird time because there's not really any good comps in history. There's a couple like little times where maybe somewhere bond yields were negative, but that was kind of an oddball, right? As far as history goes?
Yes. In fact, I call the period from 1940s to the 2020s the interest rate pyramid, because during World War II, the government pushed interest rates down because at that point, both in the US and the UK, government outstanding debt was over 100% of GDP. And the government did not want to pay the high interest rate costs. But then after World War II was over with, you had the Treasury Accord of 1951, the government allowed interest rates to seek their own level. And from 1951 till 1981, there was a gradual increase in bond yields. And they went from around under 3% up to 15%. In the UK, they went over 20%. But then after Volcker came in, he was determined to fight inflation. And as inflation went down, interest rates followed them. And then every time that there was a financial crisis, the central bank simply lowered interest rates. And so interest rates went from around 3% or even 2% in the 1940s up to 14 to 15% in the early 1980s, and then they came down to 0%. Well, if you're saying, well, we don't need to understand the past, that's not true. Because if you look at what's going to happen in the 2020s, well, I think interest rates are going to be stable. They're going to be around 4% or so in the US, maybe 3% in Europe. But these large fluctuations up and down that occurred during that 80-year period, it's just not going to happen again. So you need to go back and study the 1960s when interest rates were relatively stable in the world, or maybe the 2000s because interest rates were fairly stable around 4% for 6 or 7 years. And so that's why it's important to go back and look at history to see what is similar to the present and what can we learn from that.
As you've gotten your hands dirty and dug around a bit, what were some of the things where Bryan changed his mind about, where you looked at the big learnings where you're like, oh, the me of 10 or 20 years ago, or even just the widely accepted academic literature maybe, or even current, that you think, oh, well, everyone believes this because it's been their lifetime here or whatever. But if you actually look at history, it's maybe not the case, or it's changed your mind.
I looked at the financial eras. Then I broke it down to financial periods of 20 years. And what I noticed was there were fluctuations up and down in the equity risk premium. There are periods such as the 1960s when the equity risk premium was relatively high, but then it was followed by a period when it was low during the 70s and the 80s. Then there was a period in the 80s and 90s where it grew. And now it's, came back down during the 2000 and 2010s. Right now, we're in a period where the equity risk premium is high. And that should continue for the next 10, 15 years, but it's hard to predict the future.
This is a little philosophical. One of the big levers for someone who is a student of history, but also thinking about markets, is this lens of looking at markets through either and both a nominal or a real lens, meaning for listeners thinking about in terms of, hey, the stock market did 10% a year in the US. We're like, well, if you account for inflation, it's closer to, I don't know, making up 5 or 6 or something. And so thinking about in terms of real, because sometimes inflation is 2% and sometimes it's 10. And so a 10% nominal return when there's no inflation is a lot different than a 10% return when there's 10% inflation. So how do you kind of think about it? Because the world talks in nominal. But when you look through some of this, do you think in terms of both? Do you think in terms of one and then just kind of extrapolate to the rare periods where there's like hyperinflation or something? How do you think about it?
Well, what we do is in our analysis where we're looking at long periods of time in different countries, we convert all of our returns into real US dollars. So we adjust for inflation because, if you have a period when you have high inflation, well, naturally your nominal returns are going to be higher. But you want to look at your real return. What happens after inflation? And then you need a common currency, which is the US dollar. The US dollar has been the dominant world currency for 100 years now. If you're looking at the 1800s, then it would be the British pound. And so what you want is a common ruler. And whenever we look at the past, we use real US dollars as the benchmark to compare different periods of time and different countries, because that will give you an accurate analysis. We do not use the nominal returns. I mean, we record what they are, but to do any time period analysis or any cross-country analysis, we use real US dollars.
Well, one of the nice things about your website is it lets you download in any format, any currency that you wish. As you look back over these financial eras, any general takeaways as far as hard and fast rules, other than there are no there are hard and fast rules? I don't know. Or some big lessons learned?
Well, the importance of wars, definitely. I wrote a paper on the French returns to France, and I put in there what I called the four financial horsemen, because you have the four horsemen of the apocalypse, and they come in and they spread plague and everything. And so my question was, what are the primary factors that affect returns in the stock market and the bond market? And what I found out was that the primary factors are war. War is definitely bad for financial markets because it creates destruction and then it creates inflation. And fixed income holders always do poorly during war because in order to fight the war, the government has to raise money and they're going to repress growth in the stock market so they can direct all the money to funding the war. The second factor is autarky. Countries that try to pursue growth on their own without trade in the international environment do very poorly. That's just a rule of thumb. Third role is the government intervention in the economy. The more the government intervenes in the economy, then the worse that the economy does. And then the final factor is just inflation. Inflation is always a negative impact for the financial markets. And so if you want to say what things you need to look for in order to determine the rates of returns, those would be the four things, what I call the four horsemen of financial markets. And if those four things are available, war, autarky, government intervention, and inflation, markets are going to do poorly. But if you can avoid those, avoid war, avoid inflation, avoid autarky, have international trade, and have free markets, the markets in stocks and bonds will do well.
Obviously, the U.S. is a big shining example here. When you mention war, the question that pops into my head is it only bad for the losers or is it bad for everybody? And is it always true?
Well, obviously, it's bad for the losers because their country is destroyed. And even if their country isn't destroyed, they'll have to pay for it in France with operations. Because if you look at, for example, Germany during the 1860s, Prussia had wars with Denmark and with Austria and with France, won all three wars, imposed reparations on France at the end of the Franco-Prussian War. which is then why France wanted to impose reparations on Germany after World War I. But that created a bubble. And you can see how the stock market in the early 1870s, after Prussia unified Germany, went up, doubling in price, and then collapsed back down. Same thing happened with Japan after it had its war with Russia. Even for the victors, you get a false sense of hope, and the markets will move up dramatically, but then crash back down. But it's not only the destruction, but the way it misallocates resources and the problems of adjusting back. I mean, after World War I, it was decades, and then World War I led to World War II. There are 3 decades that were lost there, and the whole world suffered from it. Or if you look back at the Napoleonic Wars did very poorly for France. The UK generally benefited, but at the same time, you had higher bond yields, higher interest rates, and the country suffered from that. So there are negatives even for the winners in wars, but definitely the losers lose more.
With the understanding that the future will all be different, how do you think about 2024? Here we are. We're on the cusp of AI and robotics and things clearly getting pretty weird pretty quick. Do you think that like a lot of the generalizations we can make from history will be similar? And if not, in what ways might they be a little different, if that question makes any sense?
Well, I think from a technological point of view, things are positive because research continues to go into AI, into biotechnology. And those are the real growth areas globally and in equity markets throughout the world. I mean, I remember back in around 2000, everyone was talking about emerging markets and how if you only invest in emerging markets, that's where the growth is going to occur. And that's where you can make your money. But really, the growth has occurred not in emerging markets, but in developed markets and in the United States, because you have companies like Google and Apple and NVIDIA and Microsoft who have a global reach, or Meta. And that's why the markets have become so concentrated, because these companies have been able to exploit the technology and apply it to the whole world. Whereas there are very few emerging markets. India has a couple companies, but Europe has really not participated in the technological growth that's there. And so on that sense, I think things are very positive. And I think things will continue to grow. My concern is with the reduction in international trade and the fact that both parties now want to raise tariffs, want to protect domestic markets, and ultimately that will hurt everyone in the world. And in Europe, they want to fight any American technological monopolies. And that's just what will hurt growth in the future. And so I'm both positive and remorseful about the whole thing. I think you can see things hopefully can work out, but then you can see the problems that we need to overcome.
Let's say you got world leader listening to this podcast for the first time recently. We had a president retweet the podcast, not ours, but in a different country. But let's say a world leader hears this. They're like, this is great, Bryan, you're really smart. I want to hire you as a consultant. And it doesn't even matter the country, but let's just say it's like China or maybe a smaller country in South America or Africa. And they're like, look, we're going to take the long view. And I want to optimize my country and my markets to be set up for success. What advice are you going to give me?
I would say promote the capital markets, promote trade. I mean, if you look back over history, the strongest periods of economic growth and high returns to stock and bond markets were in periods where you had free trade. If you look at after World War II, you had the Bretton Woods agreements, and trade was gradually liberalized through the world, and all the countries benefited. You went from a complete depression in the 1930s to rapid growth in the 50s and 60s. The period of the 1980s, when markets globalized, by 1981, the stock market's capitalization was the lowest it'd been in 100 years. And then you had Thatcher, Reagan come along, open up the markets. And it wasn't only the US and the UK, but all the countries allowed their markets to grow. And so the capitalization of the stock markets went from around 10 or 20% to over 100%. And that was also the period when economic growth and returns to shareholders were the highest. And I think right now, virtually everyone in the United States has an interest in the stock market. Their pension funds, their 401ks, they're all invested in the stock market. So if you want to have a good retirement, if you want to have a sufficient amount of money to live off of, stock markets have to continue to grow. And if you fight stock market, it's going to hurt everyone. So think of everyone in the country, everyone in the world, promote capital markets, promote growth, and everybody will benefit. If you fight the labor markets, if you fight the capital markets, it's only going to end in tears.
You're very much a global investor, global perspective when you're doing these studies. It's not just the US. And you and I were conversing on email about this US dominance and US as a percentage of world market cap. I think it's probably 10 times the size of any other country's stock market. How do you think about that? In the beginning, we were talking about concentration and how it was all-time highs, but not necessarily a death sentence. How do you think about it in terms of countries, with like the US being not all-time highs, but getting up there as far as a percentage of global market cap?
Well, right now, if you're looking at investable markets, the US represents about 60% of global market capitalization. Now, if you're looking at GDP, we're only about 25%. So we're definitely overweighted there. But I think that's because markets are free to pursue research, invest. The United States attracts people from all over the world. If you look at who's the head of the Magnificent Seven, I mean, in several cases, they're not Americans. They're people from India or other countries. And that's a good thing. And other countries should do that as well.
As you think about not just your own portfolio, but maybe if CalPERS called you, or Harvard Endowment, or just anybody who was looking for just general investing advice, even though this is not investing advice, listeners. But how has your lens of history impacted or influenced how you think about putting together an actual portfolio, not just for today, but going forward? One of the great quotes that I think a lot of professionals might be taking it back, where you mentioned there is no single equity risk premium. And I think that was an interesting takeaway. But how do you think about putting together a portfolio with the lessons of history?
Again, it depends upon your time perspective. If you're looking at a period of you're just going to, what I say, go on vacation, you're just going to walk away from the stock market for 20 years, then equities are definitely where you want to put your money. And you want to put it into technology, because technology has outperformed the rest of the market during the past 10 or 20 years. If you're looking at shorter term, then you want a more balanced portfolio to include bonds, so that when you take the money out, you're not going to be forced to take it out in the middle of a bear market. But I would definitely emphasize equities over the long term. I have all of my money in equities because I'm looking at the long term. And I would encourage other people to do that. But again, it depends upon your time perspective and when you plan to take the money out. The shorter your time perspective, the more you want to put in bonds.
One of the things we haven't mentioned in this entire podcast of financial history, at least not much, has been things like the shiny metal. It's at all-time highs or thereabouts. How do commodities, do they play a role in the portfolio, or any other, whether it be real assets, bonds, seem, as you mentioned, a little less attractive to you for the long-term investor? Historically, I mean, if you go back a couple hundred years, that was probably most of it, right? It was like physical currencies, precious metals, hard assets, real estate. How do you think about that hundreds of years later here in 2024?
Commodities have kept up with inflation, but they haven't beat inflation. Right now, gold, I think, is attractive, but over a long-term period of time. I don't see gold shooting up in the near future, but it's had a good steady rise. And it's been around $2,000 for a decade or so. And so it's probably time for a move here. Real estate, I feel it's probably overpriced in many countries. I feel it's fully valued. I wouldn't put money into it for investment returns, but obviously it's an important part of everyone's portfolio.
Bryan, it's been a whirlwind tour as always. Where do investors go? They want to find more information. You mentioned SSRN, and listeners will throw all these links in the show notes, including some really cool charts that the team at Global Financial Data has put out. But the best place to find you, everything you got going on,
is at Global Financial Data. And then the Insights page provides links to all of our blogs. And we have over 100 blogs up there on a vast array of topics. So either SSRN for the longer term papers or Insights under globalfinancialdata.com for the shorter blogs that we publish on a periodic basis.
Very cool. Bryan, thanks so much for joining us today.
Thank you.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.